Listen to me. If you are over the age of 60 or you are staring retirement right in the face, I need you to sit down, pay attention, and turn off all the outside noise. Because right now, you are facing a massive financial crossroad, and the decision you make regarding your life insurance is either going to protect your hard-earned nest egg, or it is going to absolutely drain your wallet during the years you need your money the most. Every single day, people in their 60s come to me terrified. They are panicking because they just got a notice in the mail saying their 20-year term life insurance policy is about to expire, or they are being hounded by insurance agents telling them they need to buy a permanent whole life or universal life policy to protect their family. They ask me, Susie, what do I do? If I let this policy go, will my spouse be okay? Should I look into permanent insurance? Am I making a mistake? I understand your fear. The fear of leaving your spouse with a mortgage they can't pay. The fear of your kids having to foot the bill for your funeral. The fear of outliving your money because you are pouring hundreds of dollars a month into an insurance policy that you might not even need. But we are going to cut through the confusion right now. No sugarcoating, no industry jargon, just the raw, honest truth. First, let's look at term life insurance. Term insurance is pure protection. You pay a premium, and if you die within that term, say, 10 or 20 years, the insurance company pays out a death benefit. It has zero cash value. When the term is over, the policy vanishes. If you are over 60 and you try to buy a new term policy, you are going to get sticker shock. Why? Because you are older, the statistical probability of you passing away during that term is much higher, so the insurance company is going to charge you a premium that is significantly higher than what you paid when you were 40. But here is where the real danger lies. Many of you already have a term policy that you bought years ago, and it's expiring. You look at the renewal options, or you try to get a new 10-year term, and you think, well, it's still cheaper than whole life, so maybe I should just buy it for peace of mind. But if you don't actually have any major debts, and your spouse is financially secure with your current investments, you are literally throwing that premium money into the garbage. You are renting coverage you don't need, and that is money that should be staying in your high-yield savings account or your retirement portfolio generating income for you to live on today. Now let's talk about the absolute elephant in the room, whole life insurance. This is permanent insurance. It covers you until the day you die, as long as you pay the premiums. It also features a cash value component that grows at a guaranteed rate over time. Agents love to tell you, look, your premiums are fixed for life, they will never go up, and it builds equity. It's an investment. Let me tell you something right now, and I want you to hear me loud and clear, life insurance is not an investment. It is an expense. When you buy a whole life insurance policy after age 60, the premiums are astronomically, outrageously high. We are talking 10 to 15 times more expensive than a term policy for the exact same face value. Why on earth would you take thousands of dollars a year out of your retirement cash flow to fund a whole life policy? The fees and commissions swallowed up by the insurance company in the first several years of a whole life policy are massive. The cash value grows at an absolute snail's pace. If you take that exact same money and keep it invested in a simple, diversified portfolio, or even safe yields, you will have far more wealth, far more liquidity, and total control over your money. Whole life after 60, for the vast majority of Americans, is a monumental mistake that robs your current retirement lifestyle just to hand a massive. So, what is the actionable takeaway here? How do you protect yourself and your family without getting ripped off? You must do a brutal, honest assessment of your financial reality today. If you are over 60, you only need life insurance if you have a specific financial liability that would devastate your family if you passed away tomorrow. What are those liabilities? Number 1, you still have a massive mortgage, and your spouse could not afford the monthly payments without your income. Number 2, you have a child or a dependent with special needs who will require lifelong financial support long after you are gone. Number 3, you have zero savings, and you genuinely need a small policy just to cover your funeral and burial costs so that burden doesn't fall on your children. If you have a major liability like a mortgage, and you absolutely must have insurance, your action step is to look for a small, low-cost term life insurance policy, only for the specific duration of that debt. If you have 10 years left on your mortgage, you look for a 10-year term. Nothing more. Do not buy a permanent policy. If your concern is simply final expenses, burial costs, funeral plots, medical bills, do not buy a massive whole life policy. Look into a small, specific final expense policy, or better yet, build up a dedicated funeral fund in a safe, liquid high-yield savings account or a certificate of deposit that is completely under your control and earmarked for your family. But if you look at your balance sheet, and your mortgage is paid off, your children are independent, and you have a solid nest egg to support your spouse, I want you to stand up, look in the mirror, and give yourself permission to let your life insurance go. Celebrate the fact that you have graduated from needing insurance. You have won the game. The money you would have wasted on insurance premiums belongs in your pocket. It belongs in your retirement, supporting your health, your travel, your safety, and your peace of mind. Do not let fear dictate your financial future. Do not let a smooth-talking salesperson convince you that you are leaving your family unprotected when you already have the assets to protect them. Be strong, be smart, and be secure.